Let's go ahead and talk about deferred tax assets and liabilities arising from differences between tax and financial income. Now, we have two sets of books. We have our tax accounting books prepared in accordance with IRS regulations, and we have our financial accounting books prepared in accordance with generally accepted accounting principles. There are going to be differences between taxable and financial income. We have different rules for tax purposes than for financial accounting purposes. Now, differences can be defined along a number of dimensions. The first distinction is that some differences are permanent. These are a permanent discrepancy between tax and financial income. An item appears in one set of books but not in the other. Examples could be fines for illegal behavior. If you get fined by OSHA or fined by the EPA, that is a deduction on your financial income statement, but it is not tax deductible, so it appears on one set of books and not the other. Similarly, tax-exempt interest income. If you buy municipal bonds, the interest revenue on those is recorded on your financial income statement, but it is not on your taxable income statement. Instead of permanent differences, some differences will be temporary, and these are the ones that are going to give us our problems. Temporary differences are timing differences. The items appear in both sets of books, but they appear in different periods. Most common example that's easiest to think of would be the case of depreciable assets. You might buy an asset for $100,000 with no salvage and a 5-year life. For financial accounting purposes, you might depreciate it straight line, $20,000 per year, while for tax purposes, you use an accelerated method. In both cases, the full $100,000 asset is going to be depreciated. It'll just be done in different time periods. It'll be done at a different rate. Other differences will arise from prepaid and accrued expenses. For financial accounting purposes, expenses are recognized in the period benefited, or equivalently, they are matched to the revenues they help to generate. For tax accounting purposes, the recognition of expenses is often keyed to the payment of cash. And so there's going to be a timing difference between the time the expense is recognized for financial accounting purposes and the time it's recognized for tax purposes. And the flip side of that is going to be our unearned or accrued revenues. Again, revenues for financial accounting purposes are recognized when earned and realized or realizable. For tax accounting purposes, recognition is usually keyed to the receipt of cash. Now, differences can also be defined along another dimension. Differences are either taxable, and the definition of a taxable difference is one which results in taxable income being greater than financial income, or if not taxable, it is deductible. A deductible difference is defined as one which causes taxable income to be less than financial income. Now, temporary differences, and again, temporary differences are the ones we're going to be concerned with most. Temporary differences are either originating differences. This is the initial difference which causes our tax and financial accounting books to diverge. And again, this divergence is temporary. It's a timing difference. And if not an originating difference, then it will be the reversing difference. And again, this is the difference which undoes or unwinds or counteracts the originating difference. Permanent differences are never reversed. Again, they're not timing or temporary differences, they are permanent discrepancies. They never get unwound or undone. Now, if we have an existing temporary difference, that is, one which has already originated, we need to create a deferred tax asset or deferred tax liability to reflect the effects on our taxes when that difference reverses at some point in the future. Okay, let's go ahead and go through a simple example. Let's assume we have a firm with 0 assets, 0 liabilities, and 0 equity. So again, a very extraordinarily simple company. And at the end of 2017, we provide services for $1 million to a client who promises to pay us in January of 2018. And again, just to keep things simple, let's assume there are no expenses associated with this transaction. Now, since we haven't received payment yet in 2017, there will be no income taxes due. So if we weren't fully working through this, we'd make up the following income statement. We'd have sales of $1 million, less expenses 0, for income of $1 million. On our balance sheet, we'd record a $1 million receivable and $1 million in retained earnings. Now the problem is our balance sheet and our income statement are misleading. We have hanging over our heads a future tax bill that's going to be triggered when that receivable is collected. Basically, we're violating two of sort of our core accounting principles. We're violating the matching principle. The matching principle says expenses should be recognized in the same period as the revenues they help to generate, or they should be recognized in the period benefited. Basically, the revenues were recognized in 2017, so any tax expense should also be recognized in 2017, even if we're not paying it yet. Similarly, we're also violating the full disclosure principle. We have hanging over our heads this huge tax liability that's going to be triggered once that cash is collected, and that's not being disclosed anywhere on our balance sheet. Again, the tax isn't owed yet, so it's not a liability yet in the sense of I owe the IRS money, but it's a pending liability. It's in a sense it's a contingent liability. Liability contingent upon our being paid the $1 million we're owed. So sort of our timeline here, in 2017 we have our originating difference of $1 million, and again this is a deductible difference. We had $1 million in revenues for financial purposes, 0 revenues for tax purposes, which means our taxable income was less than our financial income, and that is the definition or the defining characteristic of a deductible difference. In 2018, we've got scheduled a reversing difference of $1 million, and it's going to be a taxable difference. Again, we're expecting to receive this $1 million in January of 2018. When that $1 million is received, that's going to go into our taxable income, causing taxable income to be greater than financial income. We need to create a deferred tax liability reflecting the expected tax effects that will arise when the existing difference reverses in 2018. So let's go ahead and assume a tax rate of 40%. We're going to be liable for $400,000 in taxes when the $1 million is collected. So at the end of 2017, we're going to need to record, and it's good to do this in sort of a little 3-step dance. We'll repeat over and over again. Step 1 is to determine how much you owe the government at the current time. Now at the end of 2017, we haven't collected any money from our client yet, so we don't owe the government anything. So taxes payable is 0. Next, we look at our schedule of future reversing differences that are reversing existing originating differences, and say how will these reversing differences affect my tax bill in the future. And again, we know that we're going to receive $1 million in 2018. When that $1 million is collected, we're going to owe $400,000, so we need to get a $400,000 deferred tax liability on our balance sheet. And tax expense is simply a plug figure. It's the sum of what we paid this year plus or minus the changes in our deferred taxes. Okay, so after recording that deferred tax liability and tax expense, we're going to have the following. Our revised income statement will have sales, again, of $1 million, less the tax expense of $400,000 for net income of $600,000. So this gives a much more accurate representation of the effects of our economic activities in 2017. The net benefit to us, after taking into account our future tax bill, is going to be $600,000. On our balance sheet, we've still got that $1 million receivable. Now we've got a $400,000 deferred tax liability and $600,000 of retained earnings. Finally, in 2018, let's assume that we don't engage in any additional earning activity during 2018, so no more business. At the end of the year, we're going to have to give the government $400,000. That's, again, the tax rate of 40% times the $1 million of taxable income based on the cash we collected. We're paying off our deferred tax liability, but there's no tax expense this year. Again, this entry is for financial accounting purposes. For financial accounting purposes, there was no revenue this year. Therefore, there will be no tax expense.